Thinking about ETFs but not sure where to start? Great. ETFs are one of the easiest, most flexible ways to invest, and here's a plain language guide to what they are and how to use them. At the simplest level, an ETF, exchange traded fund, is a basket of investments, stocks, bonds, commodities, or a mix, that trades on an exchange like a stock. Buying a share of an ETF gives you a small piece of that whole basket, so you get instant diversification without buying dozens of individual securities. People like ETFs for a handful of practical reasons. One ETF can give you exposure to hundreds or even thousands of securities, which helps spread risk. Many ETFs have low expense ratios compared with actively managed funds. They trade throughout the day like stocks, so they're easy to buy and sell, and most publish their holdings daily, so you always know what you own. There are also ETFs that target nearly any market, sector, or theme you can name, so they're flexible building blocks for a portfolio. There are lots of types of ETFs to choose from. Broad market equity ETFs track major indexes like the S&P 500 or the total U.S. market. International and emerging market ETFs get you exposure outside your home country. Bond ETFs cover government, corporate, or municipal debt. Sector and thematic ETFs focus on areas like tech, healthcare, or clean energy. Commodity ETFs can track gold, oil, or other raw materials, and there are smart beta or factor ETFs that tilt toward value, momentum, or low volatility. Target date or life cycle ETFs automatically adjust risk over time, which can be handy for retirement savers. Before you buy an ETF, check a few key things. Look at the expense ratio because that annual fee compounds over time. Examine tracking error to see how closely the fund follows its index, and consider liquidity and the bid-ask spread so trading costs don't eat into returns. Assets under management matter for stability and liquidity, and if you already own other funds, check holdings overlap so you don't accidentally concentrate in a few companies. Finally, understand the ETF structure and tax treatment. Some commodity or futures-based ETFs have different tax consequences. ETFs carry the usual market risks. If the market or a sector falls, your ETF will too. Some ETFs are concentrated in a handful of companies or a single sector, which raises concentration risk. International funds bring currency and geopolitical risks, and certain products, especially leveraged or inverse ETFs, are designed for short-term trading and can be risky if held long-term. Tracking risk means the ETF may not perfectly match the index return. If you want a simple plan to get started, begin by defining your goals and timeline, which will shape your stock versus bond mix. A straightforward allocation might be a broad U.S. equity ETF, an international equity ETF, and a core bond ETF. Choose the right account for your taxes: taxable brokerage, IRA, Roth IRA. Pick a broker with low commissions and good tools, and consider dollar cost averaging to smooth out market timing. Rebalance once or twice a year to keep your target allocation. A simple starter portfolio example many people use is 60% broad, U.S. equity, 20% international equity, and 20% aggregate bonds. But tailor that to your risk comfort. Taxes and fees matter. Expense ratios are important. Many brokers now offer commission-free ETF trading, and ETFs are generally tax efficient, though rules vary by country and fund structure. Read the prospectus and fact sheet for any ETF you own. Avoid flashy thematic products until you understand them, and check your portfolio at least once a year. If you want, tell me your goals and time frame, and I can suggest a simple starter mix to consider.